Hi, my name is Jose Hernandez, and welcome back to my Investment Basics and Principles course. This is part 2 of the series, and if you watched part 1, you will know that there are a lot of great reasons why to get started in investing in general, but the 3 things that we covered were compounding interest, why time is your best friend, and why we need to beat inflation and what it is. So, as a part of this next portion of the course, we'll be covering what the actual investments are that you can use to start accomplishing your financial goals. Retirement, buying a home, education, savings, whatever is important to you. So we'll cover the 3 types of investment classes or asset classes, as you'll learn to call them in this video. And of course, I'll give you plenty of examples along the way and make sure it makes sense, because I'm here for you and I want to make sure that you get the most out of this entire process. So let's get started. So the 3 major types of investments that we're going to cover today, or the 3 types of asset classes as we'll learn to call them, are stocks or equities, bonds or fixed income, and cash, which you may have heard referred to as CDs, money market. We'll get into what that means in a second, but I want to make sure that we have the foundation as to what these investments are, their purpose, the risk behind them. That way you have confidence and understand what they are when you decide to make the decision to become an investor yourself. We could literally spend hours on each of those investment types or asset classes, but that's not the point of this video. The point of this video is to give you the fundamentals of each type of investment and to give you the knowledge and the confidence to be able to explain what these are to someone else if they ever ask you, if you're at the bar or church or wherever you hang out. That's my goal here, is to educate you so you're confident, comfortable, and can actually apply this in your own life. So let's get started with the most common and most sexiest of the 3. That is stocks. Stocks are commonly referred to as equities, and that's simply because they represent ownership in a company. So if you've ever watched Shark Tank or read any type of business blog or seen any type of article where someone's buying a portion of a company, you'll hear them use the word equity. If the company is traded on the stock exchange, they are quite literally buying the stock of that company. So if you hear that Warren Buffett is 5% owner of a certain company, it literally means that he owns 5% of all the stocks that that company has outstanding. I'm a fan of easy numbers. Let's assume that there's a company on the stock exchange that has 100 shares outstanding. Outstanding simply means that that's the number of shares that are physically traded and that you can buy. If you own just one of those shares, you're technically a 1% owner in that company. To give you a little bit more of a real life example, let's take everyone's favorite, Amazon. If you own 1 share of Amazon, let's keep in mind that there are 488,969,000 shares of Amazon outstanding. That's how many shares that you would have to buy to actually own the entire company. And as of this recording, Amazon stock is trading at about $1,649. So if you want to buy the entire company, you just have to simply multiply 488,969,000 by, let's say, about $1,600. Pretty simple, right? So if you want to put that into percentage, let's look at that. So if you own just 1 share, you are, I gotta turn this thing sideways, 0.000002% owner of that company. You may be wondering, okay, that's cool, but how do I make money off the stock? There are a lot of ways that you can make money off a stock, but the most common way is buying it at one price, holding it, and then selling it at a higher price in the future. That's the most common way of making money off the stock. You can use other strategies that we won't cover in this video, but the primary way, again, of making the money off of a stock investment is buying low and selling high. And that's where the magic of compounding interest actually comes into play. If you remember in the last video, if you use compounding interest, which is just interest growing on itself, and you pair that with a long period of time, that can actually grow into a nice chunk of change. So, quick example here. Let's just assume that we buy 100 shares of a company that is at, let's call it $100, $10,000 investment. And let's assume that it was a good investment and every share or stock grows by $5. Remember, we have 100, So we bought it 100 shares as well. That goes up by $5. We now have 100 shares that are trading at $105. If we do the math, that total is $10,500. So if we take that and subtract it from the original investment of $10,000, that's a quick $500 profit. I'm sure you're probably wondering what makes the stock price go up or down. And I always like to think back to my finance professor, Dr. Jeff Nagini. He said there are three things that make a stock price move up or down: information, information, information. If you're looking for the economic definition of why a stock price either goes up or down, it's simply supply and demand. But as my finance professor Jeff said back in the day, it really does just come down to what kind of news or information is coming out about the company. For example, if a company comes out with a hot new product that no one was expecting to do well, that can make the stock price go up. On the flip side, maybe some not so good news came out. Maybe they had a lackluster earnings quarter, or they had a scandal in the company, or maybe it's something that the company didn't even do. It may be something that happened overseas that just happened to affect the company. So there are just a lot of different things that can affect the stock price itself. And the easiest way of thinking about it is what information is coming out about the company, and is it good, bad, or does the market not really know how to respond to it, which you'll see that happens as well. And I want to touch on risk here. Risk is a very important thing to always understand in investing. And stock are actually, we can say, the most riskiest type of investment, because there's no promise to be paid back if the company goes bankrupt, if they have a scandal, or anything else negative happens. There's just no promise. So you really need to be sure about what you're putting your money into and what the purpose of the investment is in the first place. But from a risk and return perspective, you can think of stock as very profitable, but also very risky. The number one rule in finance, or I think, is risk versus return. So a very risky type of investment can yield high returns, but just know that there will be some periods of sharp ups, but also sharp downs. And you need to understand that before you make the investment. There are tons of different types of stocks. There are growth stocks, value stocks, international stocks, domestic stocks. There are different sectors in the stock market. There are dividend-paying stocks, not dividend-paying stocks. I mean, there is just so much more to learn about stock, and we are not going to cover that in this video. What do I want you to take away from all this? Stock represent ownership in a company. That's why you'll hear stock referred to as equities. Stock prices move based off of information that's coming out or news that's coming out about that company, or supply and demand. And they are typically the most risky type of investment compared to the other two that we'll cover today. Reason why? There's no promise that you'll get your original investment back if something really bad happens to the company. Bankruptcy, they have a really bad scandal. The list there is long, but just know that there are no guarantees when you make that stock investment. And because they're the riskiest type of investment, you may see a lot of sharp ups and a lot of sharp downs depending on the company and the type of investment. So please keep that in mind before you buy a stock. Know the risk that the specific company itself has, and just make sure that you are comfortable with it. Now that we've covered stock, let's move on to the next asset class or investment type: bonds. There are a lot of different types of bonds, but I think the easiest way of explaining what one is it's simply an IOU investment that pays you back with interest. Let's start off with who issues bonds. The primary issuers of bonds are typically corporations or governments that are in need of cash. The way it typically works is if a company doesn't want to issue stock, they can issue a new order of bonds, and you as the investor have the opportunity to go in and buy that bond. As an example, let's say that the bond itself was $100. You purchase that bond at $100, and then you hold the investment for the term of that loan. Over the term of that loan, you'll be receiving an interest payment for most types of bonds, and at the end of the loan, you get that original $100 back. To provide you with some numbers to help you conceptualize how bonds work and how they pay you, let's go back to that $100 example. A company comes out, needs cash, and they sell bonds to investors. You're one of those investors and you buy one of those bonds for $100. Let's assume that the interest rate on that bond, or the coupon rate, is 5%. That means every bond is paying you $5, in this case annually. Over a period of time, those bonds will continue to pay you $5 until the end of the loan, or when the bond matures. Depending on how long the term of the loan is and the interest rate on that bond, that is how you're going to make primarily your money off of the investment. Usually if you buy a bond, you are intending to hold it until the end of the loan, which again is called maturity. Maturity simply means that's when the loan is over and you get your original investment back. But like stock, the price of a bond can actually fluctuate on a daily basis. What makes a bond price move on a daily basis? Well, much like stock, it actually comes down to supply and demand. But the easiest way of thinking about it is think in terms of interest rates. Going back to our 5% bond example, if there are new bonds that are available in the market that are now paying 6%, if you think about it, investors are going to value those bonds more because they're paying you a higher interest rate. So because of that, the value of your 5% bond is going to be lower. And on the flip side of that, let's say that new bonds are coming out, but they're only paying 4%. The market is going to value your bonds more because they are paying 5% instead of the 4% that's being found in the marketplace. There are a lot of things that dictate the interest rate itself on a bond when it first comes out. Think of it this way. You yourself, you probably have some kind of credit card or some kind of loan out there. What companies do when they're issuing you a loan, they look at how good of a lendee are you, meaning how good are you with money and making sure that you're paying back on time and how much debt you have overall. Those considerations are very similar when you're looking at a new bond that's coming out. The people that help bring the bond to market, or the underwriters and the investment bankers in this case, they take a look at how healthy of a company is it when it comes to credit, debt, etc. And then another thing that really plays an important role is how long the loan is itself. Why does the length of the loan itself matter, and why does it influence the interest rate on it? Well, one of the main things that you need to learn about in finance is risk versus return. So if you're going to be taking on more risk, in this case, you have to wait longer until you get that original investment back. That means you're going to want a higher interest rate because you are sacrificing time and you could have been using that money for other things. The main thing to take away from bonds is they are a promise to pay you back, usually with interest, and they are a contract to pay you back. Now, that doesn't mean that they're risk-free. If you think about it, a company could go under, a government could go under, a municipality could go under. It happened in 2009. So if you think about those things, just keep in mind that no investment is guaranteed, but because it's a contract and a promise to pay you back, it does make them a lot more safer than stock investments, for example. So going back to risk versus return, because the risk isn't as high as stock, you're not going to see the same level of profitability from bonds as the stock market, for example. We've covered stock, the sexiest of the three. We've covered bonds, a promise to pay you back with interest. Now let's talk about cash. What exactly do I mean when I say cash? Good question. I literally mean cash, like cash in your savings account, but there are other types of investments that are coupled into the cash category, and we'll talk about those. Before that though, I want to start with actual cash. Cash that's hopefully sitting in your bank account or savings account. Back when I had clients and was still practicing as an advisor, I would always urge my clients to have at least 3 to 6 months worth of expenses in a savings account. Why? Simply because it's always great to have an emergency or rainy day savings fund, because life is going to happen whether you want it to or not. And if you are someone that's relying on your investments at one point in your life, whether it's retirement or coming up, the last thing you want to do is have to be forced to sell those investments, hopefully not at a bad time, and sacrifice your goal, when you could simply just pull from the money that you've been smart enough to save in a checking or savings account that's been tucked away and used exclusively as a rainy day fund. In general, cash is not going to bring you much return or profitability, but that's not the point of cash. What's the point of cash? Well, we already talked about one, having a good safety net in case life happens, as we all know it will. But it also serves as a handy kind of tool to have on the sidelines. What do I mean by that? What I mean is, let's say that the market does take a serious dip. Remember, we want to try to buy low and sell high. If we have some excess cash tucked away that we don't need, that could be a great opportunity to use some of that cash to get into the market at a good time. Or if you're extremely wealthy and already have a really nice portfolio set up and you want to live off of some extra interest, you could set up what we're about to talk about, money market types of cash investments that do give you a little bit of interest on them. Now that's cash. Let's talk about money market. Money market is typically considered fixed income or a loan over a period of time, but it's usually a year or less. So not like our bonds that are usually a year or longer in terms of the loan. Money market type of investments are a lot shorter, and they're designed to almost be alternatives to cash that have a little bit of a higher interest rate than just pure savings. A CD is a really short-term loan, for example, something that you buy from the bank or loan money to the bank for, let's say, less than a year. And throughout the term of the loan or at the end of the loan, you'll either receive your original investment plus interest, or depending on the type, you might have received some interest throughout the loan and then you just get your original investment back at the end. There are also T-bills, Treasury bills. These are short-term bonds that are issued by the United States Treasury or government, and they're designed to raise money for the government. The most common that you'll see are the 90-day T-bills, meaning that it's a 90-day loan. There are 180-day T-bills as well. These are very safe, or considered to be safe, because they're backed by the full authority of the U.S. government. There are a lot more types of money market accounts and money market investments out there, but the main thing to know is it's a short-term type of loan that is an alternative to pure cash in itself sitting in a savings or checking account that will earn you a little bit more interest. Why is that? Well, because it's an actual loan to a company or government, etc. And because you're having to give that money up, you are getting compensated by that through a higher interest rate. Keep in mind, cash in a savings or checking account and money market types of investments are not going to make you wealthy. That's not what they're there for. This asset class is here to be used almost like a tool on the side to either have as an emergency savings fund, as we talked about, or something that's going to generate a little bit more interest than just your checking or savings account. Now that we've covered stocks, bonds, and cash, I did want to take a second to explain in terms of risk where these three types of investment or asset classes fall. Risk is one of the main things that you should always be thinking about in your finances and investments. Generally speaking, stock are the riskiest of the three asset classes that we've talked about. Why? Because there is no underlying promise or guarantee to make sure that you get your money back if something happens to the company. At least with a bond, which is kind of in the middle between stocks that are most risky and cash that is the least risky, at least with a bond you have some sort of promise or contract to pay you back. Now, that being said, as we mentioned earlier, that doesn't mean that if something happens to the company or the government that you are lending to, that you'll get your original investment back. And with cash and cash alternatives like money market, that's the least risky of these three asset classes because you're not really giving up a whole lot. If it's a money market investment, you may be giving up your money for a shorter period of time, usually less than a year. And the issuers of these types of investments are usually a lot more creditworthy, meaning they're pretty safe to lend money to. So a bank, for example, or a government in the case of T-bills. One of the main concepts that I want to absolutely drill down on always is risk versus return. The more risk that you're taking, the more return that you should be asking for, and vice versa. The less risk that you're taking, the less type of return that you'll be getting in exchange. So we've covered a lot of great things together. We talked about stock, which represent ownership in a company. Stock prices go up or down depending on what information is available about that company, and they are the most risky of the three asset classes that we talked about today, generally. We also talked about bonds. Bonds are less risky than stock because it's an IOU or a contract to pay you back in most cases with interest. But that doesn't mean that they're bulletproof either, as we saw in 2009 with a lot of municipalities like LA or Detroit having to file for bankruptcy. And we also talked about cash and cash alternatives like money market. Cash is not there to make you rich. It's there to either have a safety blanket or generate a little bit of interest on top of some cash savings that you have through money market. Hey guys, it's me and Penny again, hoping that you got a lot of good out of this video. I learned a lot of great things, hopefully, and I've really appreciated all the feedback so far on the videos and on my Instagram content, so thank you so much. Like last time, if something didn't make sense here, or if you want to learn more about what we covered, feel free to leave a comment below. But other than that, me and Penny are going to keep working hard to come out with this content for you. We're here to serve you and make sure that you're comfortable with investing and make sure that there's no reason why you can't be an investor yourself. So we are going to keep working for you, like I said. Feel free to follow me on Instagram at the Millennial Money Mentor, and we look forward to speaking again soon.